Welcome back to the Deep Dive. Today we are wrestling with a classic market contradiction. It's a real financial puzzle, wrapped up in a pretty big strategic move.
It really is.
We're taking a deep dive into Medi, which, for anyone who follows the Indian health sector, you'll know is the largest third-party administrator, or TPA, in the entire health insurance space.
And here is the core conflict we're laying out for you. On one hand, you have Medi, which is, it's fundamentally riding these massive structural tailwinds in the industry.
Right.
And it's just executed a game-changing acquisition. But on the other hand, the company recently reported just a devastating, sharp profit crash that absolutely rocked investor confidence.
Exactly. How can a market leader show phenomenal top-line revenue growth while, simultaneously watching its bottom line utterly collapse?
Yeah.
That paradox is our mission today.
Mm.
We need to cut through the noise. We need to understand the strategic rationale for their big acquisition, pinpoint the exact costs causing this profit slump, and then see what the stock chart is telling us about its immediate future.
The last 12 months for Medi have really been a battle between these two conflicting stories. You have this strong structural momentum, the wind at their back.
Mm.
But then you have this critical execution risk. And we need to figure out if this profit dip is just the cost of accelerating towards market dominance, or if it signals something deeper, like a real erosion of their core profitability.
Okay, so let's start with the big picture, the evolution of the business model. Medi isn't just a basic claims processor anymore.
Not at all.
They're actively transitioning from being a standard TPA to what they're now calling a health benefits administrator, or HBA. And that's a crucial distinction, isn't it?
It is, yeah. A traditional TPA, they focus very narrowly on claims adjudication. It's about processing the paperwork between you, the hospital, and the insurer. And HBA expands that role significantly.
Okay.
They're providing complex network management, policy services, analytics, and increasingly sophisticated cost control measures for big corporate clients and insurers.
And the scale they're operating at under this new HBA model is just staggering. They were administrating around, 19,050 crore of premiums in the last fiscal year, FY24?
Mm-hmm.
And their target for this current year is a massive 25,000 crore.
That scale is so crucial, and it's being fed by these huge industry tailwinds. If you zoom out and look at the whole health insurance market in India, the gross domestic premium is forecasted to grow at a high teens CGR.
Right.
Specifically, we're talking about 16 to 22% growth annually between FY22 and FY28.
That's some really robust structural growth. But, how much room is really left in the tank? Aren't these markets starting to get a little saturated?
You'd think so, but far from it. The growth runway is exceptionally long, and here's why. Government schemes still cover close to 59% of lives in India.
59%.
Exactly. So that leaves this enormous underserved space for private insurance penetration. It means TPAs like Medi have a multi-year growth runway in both the retail and the very lucrative group segments. They're still early.
That structural growth thesis makes their biggest move of the last year seem entirely logical. So let's talk about the acquisition of Paramount Health Services back in July 2025. Was this move born out of necessity, or was it pure strategic opportunity?
I'd say it was pure strategic consolidation. Paramount was a major competitor, and acquiring them immediately brought an additional 4,000 crore of health premiums under Medi administration.
Wow.
So when you factor that into their existing base, their overall market share across group and retail rose to about 24% based on last year's data.
24% is significant market control, but the real leverage, like the sources point out, is in that corporate group segment. That's the high-volume, high-margin business.
Correct. The acquisition pushed their market share in that critical group segment to an impressive 32.2% based on the first half of this fiscal year.
So this isn't just about being a market leader. This is becoming the definitive go-to administrator. But leadership at that kind of scale has to translate into more than just, bragging rights. What's the strategic value that truly justifies the cost and the headache of such a massive integration?
The value is all about operational leverage and, eventually, margin restoration. By integrating Paramount, they get the opportunity to cross-utilize their existing networks, to optimize their now combined claims operations centers,
Right.
and most importantly, to significantly improve their bargaining power. This enhanced negotiation muscle, both with healthcare providers and the insurers they serve, is explicitly aimed at restoring or even enhancing their EBITDA margins over the next 2 to 3 years as all this integration dust settles.
Okay, that sounds like a textbook case of strategic market domination. You get the scale, you get the leverage, and you improve your long-term margin profile. So here is where the story takes a really jarring turn, because the immediate financial results suggest the exact opposite. Let's dig into the financials that caused that severe market reaction.
We have to look at this quarter as a tale of two numbers, really. On the top line, the momentum was definitely there. I mean, operating revenue for FY25 was up 14% year over year.
Strong.
And in the critical quarter that caused all the stir Q2 of FY26, total income was 234.8 crore. That's robust 25.5% year-over-year growth. So the business is absolutely growing volume.
But the profit fell off a cliff.
Mm-hmm.
The market wasn't looking at the top line. They were looking at the profit after tax, the PAT, for Q2. Revenue was up, but P slumped dramatically to roughly 8 crore.
Just 8 crore.
I mean, for you listening, that's a year-over-year decline of over 60%, and quarter-over-quarter, a 65% drop. It's huge.
And that's the shock. The PAT margin just compressed violently, dropping from a really healthy 12% down to a very thin 3.5%. So the core question becomes, where did all the cash go? Management had to explain an expense jump that rose 40% year over year.
Right, which is way out of line with a 25.5% revenue jump.
Exactly. It's a significant disparity, especially for a business that prides itself on being asset light.
So what are they attributing those massive expense spikes to?
So management gave some very specific numbers tied to this whole integration effort. First, the sources note that integration costs directly associated with folding in Paramount amounted to 150 basis points drag on their EBITDA margin.
Okay, so that's things like personnel harmonization, systems integration, severance costs.
Precisely.
150 basis points just for integration. That sounds manageable, but what about the rest of the expense growth?
The second major cost driver was technology investment. They cited incremental technology spends and amortization, and that accounted for another 100 basis points impact.
Okay.
And on top of that, you had a jump in depreciation and amortization from the new assets they acquired, plus a higher effective tax rate for the quarter.
So management's argument is essentially, we are spending money now to make more money later. They're saying if you adjust for these one-time or transitional costs, the underlying profitability is actually in line with historical levels.
Correct. That adjusted number is management's safety blanket. It's designed to reassure the market that the core engine is still running fine.
But how reliable is that counterargument? You know, investors, and especially analysts, are inherently skeptical of adjusted figures. When you look at that 60% party decline, what's the biggest hole in management's assertion that these are strictly one-time costs?
Well, the biggest worry isn't necessarily the integration cost that will eventually end, it's the technology investment. If they're investing 100 basis points more in tech, is that a one-time push, or is that the new higher baseline for what they need to spend to maintain and grow?
That's the key question.
Because if that higher expense base is permanent, the whole asset-light, high return on equity investment thesis is fundamentally undermined. The market is basically holding its breath for the next quarter to see if that 3.5% margin was an aberration or a new lower floor.
Okay, so before those expense figures depress us entirely, let's remember the reason why Medi has value in the first place. Its core product is operational efficiency, and that's delivered entirely through technology. This is what justifies that whole asset-light claim.
Absolutely. Their reliance on proprietary digital platforms like Matrix, which handles corporate clients and claims as a specialized SaaS product, and Maven, which provides member services and powerful analytics. That is their moat. This tech stack is how they sell their services. It's not just about volume, it's about better, cheaper risk management for the insurers.
And what operational metrics really show that efficiency beyond just the huge number of claims processed?
There are a couple of standout metrics that tell the whole story. Yes, they processed roughly 52 lakh claims in the first half of FY26, a 26% year-over-year increase. But the really important number is network control. The average claim size growth they saw was only 4.4%.
Wait a minute. 4.4% growth in claim size? That's stunning, considering the industry medical inflation rate is pegged somewhere between 10 to 12%.
Exactly. That gap is the competitive moat. They are actively saving insurers money on every single claim by controlling costs and negotiating effectively with hospitals, all thanks to their network scale and analytics. This control is why 19 insurers use their network exclusively. They are the ultimate cost gatekeepers.
And the ultimate weapon in that gatekeeping arsenal has to be their fraud, waste, and abuse prevention capabilities. The source material really singles this out as a colossal value driver.
Oh, it's the crown jewel. Their tech focus delivered FWA savings of approximately 230 crore in the first half of FY26 alone.
Wow.
And to put that in context, that is a 50% increase in FWA value detected year over year.
230 crore rupees saved in just 6 months is phenomenal. It basically means they're recovering a significant portion of their own operational costs just through fraud detection.
Precisely. They leverage an advanced AI and machine learning framework that's been trained on over 10 million claims, and it uses over 160 parameters per claim to detect irregularities. They're even scaling this up, launching Maven Guard as a standalone platform. This proven ability to generate high ROI for their clients is the long-term foundation of the investment case.
Yet, despite this underlying operational strength, and even with some minor expansion into international benefits admin via their Mayfair and Bhutan partnerships, the market is still punishing them. Which brings us back to those non-operational investor risks.
Yeah, if we connect all these dots, we realize the market isn't really doubting the business model itself. It's doubting the execution and the stability. First, that paramount integration risk is still key. If they fail to execute all those operational synergies we talked about, the improved margins, the better bargaining power, they just won't materialize. That's execution risk number one.
And what about the governance perception issues? That seems to be a structural headache that won't go away easily.
That's execution risk number two, and it's a big one for the market. The shareholding structure is perceived as unstable. Their promoter stake is very, very low, sitting at just 4.6%.
Right.
And when you combine that with ongoing visible exits from private equity and strategic investors, like that Bessemer block deal we saw, it just creates this continuous stock overhang. This low promoter confidence and the stream of institutional selling, it raises legitimate governance perception questions among investors, no matter how good their AI is at catching fraud.
So we've got world-class technology, strategic scale, and huge market tailwinds, all countered by temporary margin erosion and these long-term governance risks. What does the technical stock analysis, the chart, reflect about these conflicting stories? The stock is down roughly 23% over the last year.
The price action is a textbook example of lost momentum, and it really confirms the market's anxiety. In early 2024, the stock was in a healthy uptrend. It surged from the low 400s to well above 650. But since then, the price structure has just systematically broken down.
It did stabilize for a while, though, didn't it? It settled into that wide trading range.
It did. It flattened into a consolidation range throughout 2025. It found strong psychological and horizontal support near 450, and then resistance up near 600 to 620. That was the neutral phase, kind of reflecting the conflicting fundamentals.
But the recent action, after the weak financial results, suggests that consolidation phase is now actively failing.
And that's the critical technical observation right now. The price briefly undercut that crucial 450 support level before starting a pretty weak corrective bounce. And when you look at the moving averages, they confirm the shift. Both the 200-day and the 50-day moving averages have flattened out and are starting to slope downwards.
And you've got the 50-day crossing below the 200-day, the infamous death cross. For a retail investor seeing that term, how scary is that technically? I mean, should they panic and sell everything?
No, the death cross isn't an instant sell signal, but it is a major structural warning. It confirms that the near-term momentum, the 50-day, has definitively shifted into bearish territory relative to the long-term trend, the 200-day. It just signals that a period of correction or bearish structure is now highly likely.
So with a mildly bearish structure and these major governance questions lingering, what are the key levels we need to be watching for something like range trading?
The bias remains mildly bearish to neutral right now. I would certainly recommend a cautious range trading approach, maybe using a sell-on rallies strategy because of the structural weakness. Your key resistance zone is tightly packed between 480 and 500-day.
Okay.
That's where the price meets recent horizontal resistance and that falling 50-day moving average.
And for downside protection, where is the ultimate line in the sand? The stop loss level.
A logical stop has to sit just slightly below the recent swing lows, so around 430. A sustained break below that would suggest the correction could accelerate significantly. For any kind of recovery, the technical picture really requires patience. We'd need to see multiple higher lows form above that 450 zone, and then a strong, sustained close above the 50-day moving average, with momentum indicators like the RSI confirming a constructive return.
Okay, so let's synthesize these conflicting narratives we've unpacked for Medi Assist. Structurally, The company's foundation has never looked better. They were a clear market leader, enhanced by the Paramount acquisition, and they are riding enormous industry tailwinds.
Hmm.
And operationally, the business is excellent, driven by compelling tech that delivers tangible, proven value through things like that phenomenal FWA savings figure.
But the structural strength is currently being overshadowed by short-term execution headwinds. The near-term market anxiety is rooted squarely in those acquisition integration costs that caused the Q2 margin collapse and the ongoing perception risks tied to the low promoter stake and continuous PE exits. The medium-term promise is huge, but successful execution of the integration and a return to historical profitability are now paramount. No pun intended.
So what does this all mean for you, the learner? The core tension here is that MediaAssist has a proven long-term competitive moat. Its ability to save insurers huge amounts of money via FWA tech and cost control. But the stock price is fixated on the transient, short-term noise of integration expenses.
Right.
So we have to ask, considering their proven capabilities, how quickly would the market re-rate this stock if the next set of earnings confirms that these integration costs were truly one-time and that margin compression was indeed temporary? What kind of significant value might be unlocked if that integration is faster and smoother than the market is currently anticipating? That's the question worth spending time mulling over.
Absolutely. The decision comes down to your time horizon. Are you investing in the operational engine or are you trading the execution risk?
A great point to end on. We appreciate you joining us for this deep dive.